Drilling fluids touch just about everything in the drilling process. We're here to deconstruct the drilling process and drilling fluid concepts to provide a deeper understanding of our industry. In each episode, we'll share information, talk to interesting people, and maybe share a few stories along the way. Welcome to the Flowline, a production of AES Drilling Fluids, brought to you by Matt Offenbacher and Justin Gauthier.
Welcome back to another episode of the Flowline. We have a returning special guest, Josh Young. With so much crazy stuff going on, it seemed actually long overdue to have you back, Josh. But welcome. For people who it's their first time to hear from you, could you tell us a little bit about yourself?
Sure, yeah. So why don't I talk for a second about what life was like the last time I was in this office. So it turns out I was here on April 11th of 2025. And if you don't remember, that was about a week and a half after Liberation Day, in which those of us who own oil and gas stocks were liberated of our net worths. So it's funny coming back here. And, I remember there was a quite optimistic message. I got to meet with the CEO of AES, James, or President of AES. And James had a pretty optimistic view. He had a view on sort of how many rigs were going to fall and so on. And, it was this like moment of respite and of sort of sanity in this just sort of insane multi-month period that ended up being one of the best buying opportunities. So with that, I'm Josh Young. I run a small investment fund investing in publicly traded oil and gas companies. And then I also, last year, shortly after that interview, actually, I launched a newsletter writing about and talking about oil and gas public equity stocks, as well as doing these sorts of interviews where I guess I'm on the other side of the microphone, and then also just sharing some industry perspectives. And I think that's part of why I'm here today. Yes,
and Josh is I don't know how long we've been friends for a long time now. It feels like I don't know. Josh is just a buddy that I guess we commiserate about our oil field exposure / careers just as much as we celebrate some wins here and there, have some glasses of scotch, enjoy life together. Good friend. We compensate him in barbecue whenever he is so gracious as to come and visit us and share his thoughts and just have a little fun. So hopefully the listeners enjoy us mixing it up a little bit. But Josh, you have some thoughts. I mean, the chaos hasn't ended. It's just changed. Tell us kind of where your mind's at right now and what you're thinking.
Yeah, I mean, it's sort of remarkable. So this is actually my solicitation. I was like, hey, Matt, I put out some stuff. You should read it. And you read it. And then I said, hey, do you think we should talk about this? And you said, yeah. And there were some travel conflicts and so on. And so here I am to chat about some of what I'm seeing. And so what was really remarkable was we saw the Liberation Day sell-off in oil and oil-related equities, followed by another bout of this recurring Middle East war between the U.S., Israel, Iran, and Iran's neighbors. And so in June of last year, we saw a flare-up of that. And so you saw oil prices go very quickly from, I think, 50 or something like that in April of last year to almost 70, I think, something like that. It shot up for a little bit and then cooled off. And my view had been that things were not done there. My assessment, I had lived in Israel for a year many years ago. I knew a lot of the people there. I sort of had a variant view on that conflict and on what was likely to happen. And lo and behold, a month and a half ago now, almost 2 months ago, that conflict reared up again, and oil prices have shot up since then. And so the reason to sort of go through that history is that there has been a collapse in the drilling rig count for oil in particular here in the U.S. since Trump was elected. And the election promise of drill, baby, drill was really not upheld. And again, whether those circumstances were out of the administration's control or whether they drove the tariff sell-off or whether they drove this war, depends on sort of maybe your view on politics. And just leaving the politics aside, there's been this great opportunity to accumulate oil producer equities as well as oilfield services equities, in my view, in that time frame. And there's been dramatic appreciation in some of these stocks. And then there's some really interesting things that are coming that I think are very different from what people are expecting, and happy to chat more about that.
Yeah, I mean, it seems to be a lot of the rumble is, okay, how long is this going to last? And then we're at $95 oil, and they figure something out, and all of a sudden there's more oil to the market, and everything snaps back. And so why would I commit to scaling up when we're going to be at $65 oil in 3 months? Granted, I'm a little skeptical of that view, but it seems to be a fairly common narrative is we don't want to expand capacity. And you're hearing this in all the earnings reports right now of hold. We're not going to adjust capital expenditures, blah, 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 simply because until the futures curve bends far enough that we feel confident next year is going to be sustained higher prices, we're not going to do anything. What are you sensing at this point?
So what I think is happening there is this sort of interesting, it's almost like a bad game of telephone, or another way to think about it, garbage in, garbage out. And so the same pundits and experts and so on that were saying that oil prices were going to crash this year because of an alleged super glut of oil that never showed up. Even pre-war, you look at the data, there was no surplus, and there were excuses for that, but there was just not. There was I think forecast 4 million barrel a day surplus. I think IEA even had 4.5 million barrels a day. All the investment banks and consultants and experts and whatever, basically, other than me and I think one other analyst, everyone else was bearish. And so very, very ultra bearish. And so I think the problem is that people really struggle to change their minds. And what you're supposed to do is when the facts change, you're supposed to change your mind. And the problem is that the facts didn't support their view in the first place. And then there's a war which really throws off their prior view. And it looks like still, when you listen carefully to what these different experts and advisors and so on are saying, their views haven't actually changed. It's just there's a bunch of folks that say, hey, this is very temporary because of the war, and therefore there's going to be a sell-off right away. And then there's other folks that say, hey, oil prices are going to go to all-time highs immediately. They should already be there. There's price suppression. This is nonsense. And then once that happens, there's going to be demand destruction and prices are going to collapse. And so they're basically just saying the same thing with some minor delay. And so if you're paying one of these expert consultants or whatever, or services or whatever, or these investment banks that charge inordinate, egregious amounts of money for their financial services and M&A advisory and capital markets advisory, and in many cases are actually your counterparty or facilitator on hedging transactions where they make $1 or $2 a barrel profit, and you are guaranteed to lose $10 or $20 or $30 a barrel on those transactions in many cases, they're just going to keep doing that. And so all of that being said, there's sort of this narrative and sort of anchoring and sort of just these folks that are always wrong and have no skin in the game and have no real consequences for being persistently wrong. And then there's a reality, which is that it doesn't matter what people say. What matters is that when oil prices rise more than 20% over a short period of time, historically, every other time that's happened, the drilling rig count has risen substantially, even in the face of a lot of pressure to not do that. So one example for that would be in 2021, post-COVID, there was this whole narrative, capital discipline, the shareholders are rising up, and didn't matter. Oil rig count shot up. I think it was more than 100 oil rigs over the following 12-month period. You go back to 2018, similar dynamic. People sort of forget this, but 2017, super glut, same sort of folks saying oil will never go up, and then oil goes up by $30 or so, and then the rig count shoots up. So, and in prior periods before that, even more extreme. So in my view, it's not a question of if, it's a question of when. And we can get into why I don't think oil prices are likely to collapse anytime soon. But it almost doesn't matter because the oil prices did collapse in late 2018, and they did collapse in mid 22, and it didn't matter because you still had the rig count rise a lot, and it was actually persistently high for quite some time, even after oil prices fell in both of those periods.
Yeah, I think that's interesting. Do you draw any parallel? So I mean, remember we had this whole like Ukraine narrative as well, right? Where it was, hey, prices are fine, that sort of thing. Then it was like, oh my gosh, we need energy, and we didn't appreciate how supply chains and everything else were global. And you looked at things like fertilizer prices skyrocketing, and sourcing issues, and kind of a rejiggering of the market between sanctioned and unsanctioned, and all that kind of thing, and a very different view. I think it went from sort of how clean is my energy to how secure is my energy, which I think us in the oil and gas industry always felt like that's the way it's always been. It just had to be relearned the hard way. Do you see any parallels with what's happening now, where we're seeing, fertilizer prices shooting up, and some of these other sort of critical things that are in short supply and a lot of uncertainty, kind of maybe realigning perspectives and values? And will it be any different this time as far as people's memories?
So this time is not different. Betting on this time being different is really problematic at a high level and as a heuristic.
Mm-hmm.
The ways in which this time is different, because it's what is it? They say history doesn't repeat, but it rhymes.
Yeah.
So the ways in which it is similar is people are positioning similarly. So they're levering up and buying oil and oil derivatives. There was a news article, apparently this big European hedge fund is down now 52% or something. I think it was 52% month to date for April, and even though they were up 30% the month before that, they were down for the year or whatever. So those things don't change, right? So people speculate on stuff in the short term, and no one knows what's going to happen in the short term. If someone tells you they know what's going to happen in the short term, make sure your wallet is closed and run the other direction fast. They do not know. They can think, and even when people bet billions of dollars on this stuff, they still do not know. Mm-hmm. So there's a few ways in which this is different, very different from the Russia-Ukraine war. So the biggest differences are, one, that global inventories are collapsing right now in real time. And so in the Russia-Ukraine war, inventories fell for a short period of time. The market responded a lot to that. And then inventories really stopped declining too much. And you did see the Strategic Petroleum Reserve get released here. We called it the Midterm Petroleum Reserve because there was not a shortage of oil, but it was released anyway in order, it appears, to impact that sort of midterm election. Because, again, there just wasn't a shortage of oil, so there wasn't really a reason to be releasing until, like, let's say, October of 2022 or something. That was not a reasonable time to be releasing an emergency reserve of petroleum. And so this time is different in that inventories are falling a lot more persistently, and then they're likely to fall even if the Strait of Hormuz opened today, which is not happening, unfortunately, for the world, and maybe fortunately for the oil industry. And every day that it does not reopen, there's somewhere between 10 and 14 million barrels a day of oil supply that is lost. And it's not like it's burned up; it's still in the ground for the most part. But that's a really big difference, and it's sort of this ratchet effect where the longer the strait remains closed, the larger the inventory impact there is, and there's not a linear relationship between inventory levels and price. And so what people, I think, are seeing is that I think there was an expectation, Strait of Hormuz is closed, oil goes to $250. Again, a bunch of analysts are calling for that. It's not really how it works. And I got a lot of flack for saying, hey, like, guys, slow down. Like, I am bullish. I do even have a 250 WTI hat. But that's not saying that it should happen right this second. That's a view on sort of what happens through the cycle. So when you look at how it plays out between price and inventories, there's a wide band where changes in inventory levels have minor impacts on price. And then as you go to lower levels of storage, you start having a much larger impact on price. So your first 100 million barrels of inventory lost, if it's a one-off event, may have almost no persistent impact on price. Maybe you get $1 high or something like that. But your billionth barrel lost, that 100 million increment to get to that billionth barrel may have a $3 impact on price. And so as it goes on, I think people had these sort of fixed ideas of price relative to inventory. They had these ideas that oil prices should skyrocket. When that didn't happen, they started going towards the conspiratorial aspect or the physical versus paper oil, blah, blah, blah. And there's some nonsense there. And then also, I think some wish casting, I guess is the right way to say it, by like the IEA and EIA and some of these other folks that really want demand destruction for oil. So they're like, well, there's not enough oil, therefore you're going to lose. I think Goldman came out with something today, 4 million barrels a day or something of demand destruction, which is nonsense. Like, you can look at the historical price correlations. Maybe there's people using less oil right now because they physically can't get it, but when they get that oil at the price they're paying for it, they will consume it. So it's not, it's if you want to buy a muffin, but they're out of muffins at the store, that's not demand destruction of the muffin. That's, they need to restock, and then you get your muffin. Okay. So you know, I think there's
love the metaphor.
I know, right? Like, it's just sort of a weird way for people to think about this. And so again, why does that matter for drilling rig activity? Why does that matter for prospective customers of oilfield services? And by the way, there's no affiliation, and I don't own your guys' stock. This is just, you know, my analysis. I own other related stocks, but not yours. I have nothing directly to gain from this, and it's just so interesting to see all these folks saying, hey, you don't need to drill more, and all these companies talking about capital discipline, which again is good. As a shareholder of those companies, it's good that they're disciplined, but they should also be, I think, taking advantage of the current situation. And because of the dynamic, which is so different, of inventory depletion, so different from what we saw in 2022, as the main driver of repricing oil in the short term, I think it makes sense to start bringing rigs on. And maybe it's not any one customer going and putting on 10 more rigs, but that incremental rig makes a lot of sense for many oil and gas companies, particularly ones that have large financial hedges in place, so they're locked in at 60 or 50 or whatever dollar oil. That incremental rig can drive a disproportionate amount of cash flow, particularly in a right tail scenario. So if oil goes to 130 and stays there, let's say, for 6 months, they're going to really miss out if they aren't putting their rigs on now, because by the time they panic and put rigs on 6 months from now, they won't get the first production for another 6 months or year or whatever, or at least in scale. And so by that point, it will be like bringing on production in 2023, where prices were already starting to fall and where service costs had risen. And so there's a real risk, I think, to these companies if they act too late. And there's also a risk. Look, I'm not saying any individual company should put on too many rigs, because there's a risk that prices do pull back. And so I think the risk management approach has been sort of hijacked and is sort of too conservative and sort of disconnected from reality. And the reality is, it's not about coordination as an industry or whatever. There will be more rigs brought on. We're already starting to see some of them get brought on, and it's just a question of the winners, which is the companies that bring them on the soonest and pay the lowest day rates on the rigs and related services and so on, and have the best relationships with their service providers because they were the early actors. And then the laggards, who end up paying more and then potentially are at risk of bringing on their production too late and into a declining price environment, let's say in a year or two.
This is actually really interesting that you mentioned this. So at the AAD had a fluids conference a couple of weeks ago that I attended, and Diego Tellez of Oxy presented it was a slide that was very captivating of just basically coming out of every, what you call it, downturn, as prices rise and rigs are picked up, how efficiency drops. Like how there's this learning curve where you see this sort of decline and then it picks back up, but this is the, bringing on inexperienced people and that sort of thing. And so perhaps like my line of thinking from hearing what you say would almost be like, okay, if you picked one up now and were able to get the like kind of people who are sitting at home but haven't been they're ready to go back to work, they haven't been sitting on the sidelines for very long, you're going to probably, as a first mover, not only benefit from maybe locking in some lower pricing, but also like experience where like when things go nuts, if we had $130 oil or whatever, if you have a pulse, you're probably going to get a chance to work on a rig. And, at that point in time, there's a big learning curve. There's a lot of concerns about safety. There's a lot of other things that can affect, performance and efficiency, where that incremental rig is less beneficial at first, at least, as opposed to sort of the early movers. I don't know. What are your thoughts on that?
Yeah, I have a lot of thoughts on that. So one of the big things I got wrong coming out of COVID is I saw these rigs coming on, and I think I underappreciated the learning curve. And because of COVID supply chain issues, I was watching for changes in productivity, let's say 3 months in. And so my expectation was, hey, they'll figure these things out, and let's say by 6 months, they should have much more productivity, and they weren't getting it, the new rigs that were brought back on post-COVID. And I interpreted that as shale degradation, and there had been rock degradation, but there were also technology improvements, and there were also operational method improvements. And so what ended up happening was, with the COVID supply chain disruptions and a lot of the employment disruptions, it took longer for those rigs to get more productive, and then they got way more productive, and those productivity gains way overwhelmed the degradation of reservoir quality and rock quality at the time. And so that made me a lot more cautious in evaluating these sorts of things and in sort of making bold claims on prices and forecasts and whatever. The situation we're in right now is very different. We're 4 or 5 years out in terms of inventory depletion, and inventory depletion, similar to inventory counting versus price, is nonlinear. And so there's a real risk that we're in a situation now that is very different from the 2021-22 timeframe. And again, this isn't a this time's different. It's just it's different from that scenario, and it's much more similar, I think, to what played out in the 1970s. And so we weren't alive back then, but in the 1970s, you saw an increasing number of rigs added in response to supply uncertainty, but also in response to reservoir degradation and inventory depletion. And people remember the OPEC thing in 1973, they remember the Iran Revolution in 1979, and they don't know that there were huge discoveries in the 50s and 60s that were predominantly depleted by that time. And so you saw the rig count in the U.S. rise a lot, and you saw U.S. production not rise for multiple years. And what that did is that shocked price, and it induced even more rigs coming on, which had even more productivity issues. And then, your incremental inventory right now, if let's say you're a typical operator, let's say running 10 rigs, your 11th rig is probably going to go on to some decent inventory. But if you added 20 rigs, that 30th rig that you're adding, that inventory is gonna be really tough.
Yeah.
And so that's sort of an extreme, but then as you dial it back, you say, look, like that 11th rig probably is going to be a lot less productive in terms of incremental production versus the first rig.
Yeah.
And so as you bring those rigs on, it's not just that ramp up period that is going to impact things. It's also that by its nature, you're going to be addressing lower quality, higher price break-even inventory. And so the combination of the human effect like you were describing and the productivity ramp-up effect, along with the degradation in inventory productivity purely by the nature of forced ranking, but then also because of the many years of inventory degradation and depletion that we've experienced since then, since the last boom, 21-22, I think that combination is very similar to what we saw in the 1970s, where you saw more rigs added, but not a lot more production added. And so you can get into the sort of like this circular phenomenon where you have higher price, so it induces more rigs, which incurs more cost, and it drives up price on a day rate basis on the rigs, as well as across the whole sort of value chain. And then those higher break-evens require even higher oil prices to drill even more wells, which are even less productive and cost even more, which requires even higher oil prices and so you can get into this sort of circular price to productivity loop, essentially, and that's where you get It was sort of similar in like the early 2000s too, with the difference being that it wasn't a productivity degradation there. That was more of a demand pull type scenario, but same problem where the incremental inventory was more expensive to address and less productive. And that's where you get into a real bull market for oil, not the sort of temporary thing we saw in 21, 22.
Yeah.
And that's why it's so important. There is a reasonable probability of this. It's not 100%. I think it's likely, but there's a reasonable probability. And for the risk managers out there and the financial types who are now CEOs of companies or who are sort of like making these decisions or on the boards or whatever, I think everyone's so focused on looking down and protecting their downside risk that they're not considering this upside risk and what their losses look like on their hedges and what their foregone high price revenue looks like, and then the operational momentum and financial momentum that they give up by not taking advantage of the current situation. And again, I'm not saying these companies should do anything dramatic, but increasing activity by 1 rig, by 2 rigs. For some of these companies running 30 or 40 rigs, hey, maybe they should run 4 more rigs, something like that. I think there's really opportunity for them, and we're already seeing the private companies start to line up rigs.
Yes.
And we're already seeing many, many inbounds into the drilling rig companies. And again, I'm talking about rigs, but rigs are sort of the forward mover for sort of this whole oilfield services complex.
Right.
And so it's happening anyway, and it's just a question, I think, of is XYZ large independent or integrated or whatever going to participate in this, or are they going to miss out?
Yeah, I mean, it's quite interesting, and I really appreciate, a lot of our conversations start around a common narrative, and then you provide some nuance and some insight that sort of alters or influences the way I think about something I had thought about before. And, I think that everybody talks about tier 1, tier 2, tier 3, blah, 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 and, how do you rank it and all that. And it's like, well, higher oil prices, tier 2 becomes tier 1 because it's – but the fact is, I think a lot of those things is like, no, this is actually overlooked. Like, and tier 2, tier 3, like you mentioned, that it's not like there's just as much tier 2 that looks like tier 1 when you with a higher oil price. It's a lot dirtier and a lot messier. And so, that's possibly going to, push you into a cycle like you've talked about.
Well, there's one thing on that where as you go from, what you're talking about is an economic ranking, right? Where a well that would have, let's say, generated a 20% rate of return at $70 oil generates, let's say, an 80% rate of return at $100 oil. And so it sort of force ranks itself up via a higher oil price or higher, let's say, 12-month out oil curve, forward curve. And so one of the important things to consider with that is that those wells that are that lower rate of return typically also come with higher decline rates. And this is less true on conventional wells, but it's very much more true on shale wells. And so when you look at where operators are garnering even their tier 1 or core today inventory at, let's say, $70 oil, a lot of that is taking scabby rock that was tier 3 or tier 4 and just drilling a longer lateral. And so that's fantastic from a rate of return perspective, IRR, right? Because you pull forward production. It's not so great from a return on investment perspective. So your money in versus money out is not fantastic. The speed of it is fast, but the multiplier effect is quite low. And that effect is exacerbated as you go from, let's say, a decent location as a 4-mile lateral to a less decent location as a 4-mile lateral. And as you move towards that, driven by higher price, you get even higher decline rates and even lower production rates.
Right.
And that's where, when people look back in that sort of 2010 to 2014 timeframe and look at some of the Bakken wells or some of the early horizontal Permian wells, you get a lot of newbies essentially looking at that and saying, oh, that was ridiculous, what terrible wells. The reality is that those were actually great at that time, and they were sort of pushed into those sorts of wells because there was that rate of return, and even with lower, like much worse technology and way longer days drilling and way less oil coming out of it, the economics were still compelling. But as they were sort of pushing that fringe at the time, decline rates were rising, and well productivity was falling. And again, we had this whole shale revolution, but at this point, we're sort of on the back end of that. There's not the next new big play.
Right.
You see in the Oil and Gas Investor magazine, they have like one play, one little part of the Permian where there were 4 wells that were spectacular, and congratulations to that operator. And there's maybe 20 more locations for that. And then you can see wells drilled on both sides that were quite inferior, and fantastic big operators selling off assets right near there, seeing these big results because they know they're not repeatable.
Yeah.
And it used to be that there would be these giant wells every quarter, right? It was this like sort of smoke show between like an EOG and a Devon and a Pioneer and a Concho, and you had these huge wells in the Midland Basin and even bigger in the Delaware Basin, and that's all gone. Right? Almost all those wells have been drilled. All the 10,000, 5,000 barrel a day wells, they're gone for the most part. And so those held up, I think, the EURs a lot more. Those held up the sustainability of that production. And so I think as we go into this next cycle, I hope we find more zones that are really highly productive. But there's a real risk, I think, that we end up drilling just a ton of wells that are way less productive, high return in a higher price environment. And that price environment, by the way, gets dragged up by high break-evens that are necessary in order to supply the market. And so as you get into these lower inventory levels, tying the inventory, specifically the inventory in storage of commercial oil available for consumers, refiners and so on to actually process, versus drilling inventory that's addressed, there's a direct link between there being less inventory in storage and high enough price to go drill those marginal wells. And the thing I think people are just not connecting is that as you get that higher price, you get even lower levels of inventory, which drive you to even lower quality reservoirs and even, fringier shale fields and shale activity, which has a circular effect. So that's sort of the other way to, I think about it. And the other component of that is that as you start doing that, you need to drill more and more wells in order to get the same production as you would have gotten on more core wells.
Right.
And then even when you have that sort of high initial production rate from your 4 miles in the Bakken or wherever, then your decline rate's way higher, and so you end up having to drill even more of them. And so what that does to services costs as well as services efficiency, I'm sure AES is really well positioned for this, but everyone else, they have real problems.
Yeah.
And so that's a reason I think to consider this sort of circular dynamic, and we're already seeing it, right? Like the very best capital allocators out there are already on the private side, are already locking up rigs. They're already putting in these RFPs. They're already working towards ramping activity. And I think people hearing this and thinking, hey, that's like, it's too early, let's see. By the time you get around to it, if that's the approach, you're going to be late, not early. And again, like, will this really affect oil prices over time? Are you going to be the marginal supply that's going to crush price? The reality is that the disruption right now in the Strait of Hormuz and the giant amount of inventory, it looks like we're close to 1 billion barrels that have been lost so far through this war so far. And then, likely on reopening. And so every day, that's another 10 to 14 million barrels lost to commercial inventories and to SPR inventories. So there's really this is just getting more extreme. And so, I own a lot of drilling rig stocks. I own a lot of producers that I think will benefit from this dynamic. And, I think it's just so amazing to see basically the same thing happen as happened 50 years ago. But it's not like what happened 4 years ago. It's not like what happened 10 years ago. And people just I think can't process that. And so they just won't consider it for now.
Well, I think we have this huge tendency to lick our wounds. Past 10 years have been rough. And I think that it is so interesting to wrestle with how do I kind of protect what I have for fear of getting beat up again. It's because I think about it a lot of how do you have this sort of, growth mindset when, your mind has been so aggressively molded to like batten down the hatches and let's survive at $55 oil, because anytime I've gotten a pop, it's been short-lived, and then I'm looking around figuring out what I'm going to do next. I have a very cynical question for you based on your Permian comments. How negative does Waha go?
Actually, I'm pretty excited about this for now.
Yeah.
So because of the slow ramp up in the rig count in the Permian,
Uh-huh.
we've seen very few rig additions recently.
Mm-hmm.
We will see a lot, but we've seen them very few, and we're seeing an enormous amount of takeaway capacity coming to West Texas and Southeast New Mexico, and we're seeing huge data center projects moving towards being turned on from a generation perspective. And
So they're like, these are in the ground, ready to go, or they will be to actually utilize this extremely low cost. I guess, Josh, you're so active on X, or as the as the young people say, or Twitter, and I think it's fascinating to see like prices way up here and there, and then somebody being like, well, look at Waha, for 30 straight days it's been negative $8 or something, and so. Anyways, it is interesting because it seemed like screaming for a beneficial use.
Well, it's coming. It's coming in size, and we're you're seeing there's a new LNG facility that just turned on. I think it was at Golden Pass or something.
Yep.
And that's going to be 2 BCF a day, I think, just for the first train, which is exciting because they're going to do multiple expansions on that one. So obviously that's Gulf Coast. That's not Permian, but you have, I think it's 6 BCF of gas that's supposed to be coming out of Waha this year. And then a lot more next year. Actually, I don't know if it's more than 6 BCF next year, but incremental gas coming out next year. And you're starting to see data center projects. I think we're getting close to a BCF this year of gas that's going to get consumed in the Permian for Bitcoin mining, data centers, and so on. And I've seen numbers as high as 3 BCF for next year.
Wow.
Which is just stunning when you think about just how much. I mean, that's like 20 gigawatts or something, depending on how efficient you're going to get. But you have this giant project out in, what is it, Abilene, near Abilene?
Yes.
And that's
massive.
ramping. I mean, you can see the satellite images, and you can see people like send drones and stuff and do videos of that, and that's ramping. And there's many projects like that. I mean, that's the big one, but there's many projects. So I actually think that Waha, there's this tendency for it to go from real negative to real positive, and I think that we're about to get into an overpiped situation for Waha, absent, let's say, hundreds of rigs coming back to the Permian. And so, I mean, even in my bull scenario, I think maybe you get 100 more rigs. I don't think it'll be enough, but I think, like you said, companies are being very conservative, and I think they're being appropriately conservative. But again, I just think people got so burned, frankly, by their oil advisors, right? Like these bankers, and this is not going to make me any friends, but the bankers, the consultants, or whatever, they were all wrong. And they cost them so much money while getting paid. It's not like they have to return their giant consulting fees. It's not like they have to return the fees they made on the hedging advisory. And so, they're like, if they're sitting there and getting same advice from these guys that cost them billions of dollars, maybe they should just like slow down and think, hey, maybe it's time to consider a different alternative. And the reality is that some are. And there's already some of that momentum, and so I think what you'll see is the folks that are sort of most cautious, they'll end up being late, and then they'll panic, and they'll end up picking up 5 rigs or 10 rigs, when the reality is that may not be necessary to offset some of the damage that's been done by some of these hedging programs. And so maybe putting on 1 or 2 rigs now versus 5 rigs later will sort of offset, have a sort of offset effect, and then there's the added benefits of, hey, if you go put on a rig now and it's, let's say, 33,000 a day instead of 6 months from now, maybe 43 or 53,000 a day, and the associated services are also cheaper and also better, like you said. Of course, everyone tries to staff their equipment with the highest quality people possible, but there is a reality, which is that if you were a buyer at a cyclical low of services, you're going to get better treatment by the service providers. I mean, it's just the reality. So you're a better customer, so you get treated better, and so you want to be a better customer. And I think the way for the companies, and this isn't really how people think about it, but it matters so much. I noticed this. I was at lunch with a multi-billion-dollar Canadian E&P company that's done phenomenally well operationally. Their stock has way outperformed their peers. And I noticed in their presentation, they had mention of their major services providers, and they had a picture of a rig, and they cited sort of where it was from. I asked them who they used for their service providers, and they were thrilled to talk about it, which is unusual for E&Ps.
Yeah.
And they were, I think they're actually, they use you guys for fluids, but
of course they do.
Of course, but I was more focused on the drilling rigs and on the pressure pumping and so on. And I find that the people that are that do the best, they're sort of most consistent with the work that they award, and they're the most, I think, dynamic, where these guys, they're more gas oriented, but when the gas price goes up a lot, they'll add a rig, and then they'll go and hedge and so on to sort of backstop the cash flow. They won't ignore it entirely. They'll go respond, and then if prices fall a lot, they'll go and drop one rig. And so they're actually quite quick from that perspective to respond dynamically. And then many of their peers take longer to respond, and then respond with a lot more. And then if you look at the various financial measures for this company, they have these really good relationships with their services providers. They have really good performance relative to offset operators, and that performance ties in to better return on invested capital, return on equity, and so on. And so it's one of those things where, it's an overnight success over 20 years of just sort of maintaining these relationships and being intelligent about capital allocation. And I think we're going to see, similar to what we saw in 2021, we're going to see this next wave of this, where the better capital allocators on the E&P side end up benefiting a lot. And I think in this case, in this environment, the better allocators that I'm seeing are going ahead and adding that additional rig, hedging a portion of it, and making sure that they lock in their best equipment.
Well, I love it, and I love the idea of many of our wonderful field people probably having, getting to stay busy, and shameless plug, they'll need some quality drilling fluids, and I might know a drilling fluids company that can help. But Josh, you've given us a ton of your time. This is always so interesting. Do you have any closing thoughts or anything we missed, or are you ready to wrap up?
No, I'll plug the newsletter for a second. So
yeah,
I wrote
absolutely.
About this, recently, I'm actually putting out another sort of follow-on piece on this sort of rig efficiency study and forecast of rig activity. And I guess just the one other thing, this view is very contrarian. So there's various folks that analyze oilfield services and publish on them and so on, and charge a ton of money for these reports. And I don't know what they're looking at. I can see their analysis, and I just think it's wrong. And so I think there's a lot of risk in relying on these various other things. And so I'll plug my much, much less expensive newsletter, which is mostly focused on identifying individual stocks that I find interesting. But in the process of doing that, there's all this analysis that I make available for probably 1/10 of the price of some of these much more expensive industry reports. And so far, the analysis is actually, it's done so well that I think I have to these days promise that it'll do less well than it's done, because the statistical odds of it actually being as right on all these different macro calls as it's been since it's been launched less than a year ago is exceedingly low. But so far, the hit rate's been good, and it's called Bison Insights, and it's available at bisoninsights.info. So that's the plug, and there's more analysis coming out shortly on this rig dynamic and on what it may mean for oil prices as well as for oilfield services activity.
Well, thank you for your time, Josh. I'm proud to call you a friend, and I always love to hear your insights into things. See what I did there? But to our podcast listeners, if you have any thoughts or comments, please reach out to us at Flowline Podcast at aesfluids.com. You can also reach out to us on LinkedIn. You can follow Josh. You're active on LinkedIn as well, but I'd say Twitter is probably your best known for, and your Josh Young shouldn't be too hard to find. So with that, wish you all the best. Take care.
Thank you.
Thanks for listening. Please tune in next week for another exciting episode of The Flowline. And remember, may your returns always be full and your trips always smooth. Views expressed in this program belong to participants and not their employees. The program is for informational purposes only and cannot take the place of seeking professional advice. Copyright AES Drilling Fluids.